Today we're going to be talking about the new tax legislation known as the Big Beautiful Bill. So this bill is this new tax overhaul that is being pushed by the Trump administration, and so now it's garnering all of the buzz in corporate America. So let's talk about it. So in case you don't know, this new bill that's going to go into effect could potentially impact you and your business. So here are some things that you need to know about the bill. And just so you know, I read it, I took time to research it, so you don't have to. Hey there, and welcome to Taxes with a CPA. I'm Adrina, a certified public accountant with over 10 years of Big Four and public accounting experience. Whether you're studying for your CPA exam, climbing the corporate ladder, or building your business, this channel is your go-to for real-world advice, expert strategies, and proven tips for success. Let's get into it. So when it comes to the new Big Beautiful Bill, there are certain aspects of the bill that I want to specifically focus on that could immediately impact you and or your business within the next tax year or this coming filing season. So we're going to break it up into sections, first starting with the common deductions, common credits, retirement savings, and then finally what the IRS is doing to implement enforce tax reporting for Americans all across. Starting with the standard deduction. So this one is a major area of focus because many people have complained that this new bill is going to give a huge tax break to the wealthy while leaving the poor or middle class income earners to be left with nothing. But again, I say that's not the truth, so let's go ahead and see what the bill actually talks about. So regarding the standard deduction, so currently the current tax rate that was implemented by the TCJA, previously implemented by the Trump administration, is still in effect. So with this new bill, you can see anywhere from $1,200 to $2,500 per filer that can be single, married, filing jointly, head of household, because of these new additional standard deduction and the increase in tax brackets. For example, the filing status for a single individual as of current, the standard deduction is $14,600. Under the Big Beautiful Bill, that amount is going to go up to $15,750. For married filing jointly, it's currently $29,200. That's going to go up to $31,500. And for head of household, it's currently $21,900, and that's going to go up to $23,625. As you can see across the board, that's going to be an increase in standard deduction of roughly $1,000 up to $2,500. Next up on the bill, something to consider is for seniors. So seniors 65 and older get an additional $6,000 deduction, specifically related to the standard deduction. So again, this is something that's going to be helpful, especially for those seniors that are living on fixed income. This is now going to supplement that income and put a little bit more back into their pocket. So regarding the child tax credit and earned income credit, specifically child tax credit, this one is one that's been commonly argued within both the House and the Senate regarding the amount of that deduction. So within the bill, the Senate proposed a child tax credit of $2,200, while the House proposed a child tax credit of $2,500. The final amount that will be agreed upon by President Trump is not yet clear, but roughly Americans with children under the age of 17 can expect to see an increase in the child tax credit of about $400 per child, which is additional savings that they can use towards daycare, child expenses, or whatever. So this is something that you want to keep in mind if you have eligible dependents that you're going to be claiming come next filing season. Additionally, we have the earned income credit. So the earned income credit, again, on the current law, it varies by individual to individual. So based on your earned income, you could qualify for the credit or you could not qualify for the credit. But something that I do want to mention is that moving forward, starting 2028, there will be a certification requirement for individuals who are trying to claim the earned income credit. And this is to increase the Trump administration's desire for stricter documentation and making sure that individuals claiming the earned income credit are U.S. citizens or qualified individuals. So that's something that if you are someone who potentially may fall into that category, you want to start planning now and gathering proper documentation or going through the certification process to make sure that come 2028 you are eligible to claim the credits that you desire. Next up, we have retirement savings. So overall, the retirement savings stipulations didn't really change between the prior law and the current law. I do want to mention some things though that are going to be increasing, as specifically regarding to the Roth IRA and the Roth 401k. So again, the current current contribution amount is $7,000 plus an additional $1,000 for a catch-up. So moving forward, for individuals 50 and older, that amount is now going to be $8,000, allowing an additional $1,000 for seniors to be able to put into the Roth IRA. And in case you don't know, a Roth IRA is after-tax dollars that you can put into a savings account. So when you do withdraw those amount or the earnings on those amount, they will not be taxed. So this could be a good tax vehicle or savings vehicle for retirement that you might want to consider now that the laws have changed, especially if you or someone you know are 50 or older. And another one that is gaining traction is the emergency savings. So prior to this new law, within your 401k, you could not save up, say, an emergency fund or a rainy day fund. And this is something that was commonly argued in both the House and the Senate. So with this new bill, what it allows Americans to save within their 401k up to $2,500 of emergency fund that they can use. Is going to be tax-free when you do withdraw it with no penalties, and this can go into expenses, especially with this new tax landscape. You never know what could be imminent. So this is another vehicle which you might want to look into and see if you can take advantage of it now. And then finally on that line, we have the Trump accounts. So these were not in the previous TCJA bill, and they're not going to be in this new tax legislation. So what the Trump accounts are is an account sort of like a traditional IRA that is set up for dependent children of yours that you can contribute up to $5,000 a year within the account, and upon opening the account, there's an additional automatic $1,000 distribution to the account. And for individuals, say for example, if you are a freelancer or self-employed and you own your own business, this is something where, again, another vehicle to save for your children, your dependent, and your loved one. You can actually, as a business, you can contribute up to $2,500 within that account as well. So you, the individual, can put $5,000 contribution. When you open the account, you get $1,000 contribution within the account, and then your business can also contribute up to $2,500 within the account every single year. So this, again, I think is a really great bill, a really great factor of the bill that I think could potentially help a lot of families. So there's something, again, to look out for. And so honorable mention is freelancers and content creators / influencers. And prior to the bill, we all understand that because of the regulations regarding cash payments and freelancing, there was a huge need for these third-party apps to send out 1099-Ks for individuals that were operating using the platforms and earning or distributing up to $600 per year. And so now the good news is that amount has been bumped up to $5,000. So if you're receiving $600 from freelancing, a content creator, being an influencer, you no longer have to worry about receiving a 1099 unless that amount reaches $5,000 or surpasses it. However, as a CPA, I'm here to tell you, just because there's no requirement to receive a 1099-K does not mean that income is not subject to tax. So make sure that as a freelancer or influencer, as you're receiving income, you're properly documenting those income and reporting them as you receive them, and also track your deductions, because not only do you want to report the income, you also want to make sure you're taking advantage of all of these amazing deductions that are now presented to you within this new bill. And finally, IRS enforcement. So since 2020, the IRS has really been trying to hone in on making sure that taxpayers are compliant and trying to enforce that compliance with increased audits. And so within the new bill, there's a huge push for increased audits for businesses, individuals, high income earners, corporations, you name it. And so one thing that the bill does caution is that if you make under $400,000 or less, you're not going to see an increased audit. They're trying to go after those bigger entities. However, I do caution you that make sure you're still maintaining proper documentation, because just because there's no increase in audit does not absolve you from being audited. You could be audited at any time, any day. So make sure you keep proper documentations. You record every transaction properly so that when you do get audited, you have the proof to back it up. And finally, I hope you found this video helpful. Look forward to my next video where I'll be busting the myths on the new tax bill and sort of putting some ease to some of the questions that you may be having. I'm going to link it somewhere on the screen, and I look forward to seeing you in my next video. Bye.